Um, there we go. I'll say it again. Welcome, everyone. One thing I'll just note, I was saying to Jason, I just realized there's a soccer game on at the moment, so I won't be offended, and neither will Jason if you decide to hop off during it or you're not paying as much attention to the presentation.
Or we
Uh,
could just give up live updates as we're doing the presentation.
there we go. We will have a recording of it along with the slides, so don't worry if you miss part of it. We'll have a copy of all that stuff sent out to you. Okay, so getting things started here, the more things change, the more things stay the same. I think this resonates with our outlook for this year. And if you look, obviously look at this picture, over 100 years, it's interesting looking at side by side how similar they both look. Maybe we'll jump to the next slide here, Jason. Oh, yeah, the disclaimer. So we were looking at kind of how to kind of sum up, what we're going to talk about today. And frankly, we just took the summary from the presentation at the beginning of the year, and there's really only been one change, I would say, Jason, that we've seen and are forecasting, and that's having to do with the Fed. We were expecting them to kind of be in easing mode. Obviously, what happened earlier this year and continues to kind of bubble up is the conflict in the Middle East. Um, and again, we'll talk about it in a little bit, but the Fed, is a little bit more hawkish today than they were perhaps going into 2026. Pretty much everything else is still holding, from, the fact that as we get higher valuations, we're probably going to see higher volatility. AI continue to be a big theme, driving not only the spending of companies, but also productivity increases both at company level and the economy level. And I think that trying to time exactly where we are in this bull market, I mean, we've kind of dubbed it late cycle, but it could still be mid cycle, and it really comes down to a variety of factors, which again we'll get into later in this presentation. The biggest one being corporate earnings. So why don't we jump to the next thing? So before we get started here, just wanted to quickly review the main mandates that we have from a kind of a risk reward standpoint. Some of you have all of them, and some of you only have one of them. From the left there, obviously, is the lowest risk is our managed income. It is rated low risk at Raymond James. To the opposite in the select equity, it's not high risk. It's considered medium risk at Raymond James, but it gives you a bit of an idea just kind of where we see the risk reward. So sometimes when we're talking to you folks, you may be concerned about markets or concerned about drawdowns and things like that. And the portfolio you may want to make some changes. Enhanced yields in your portfolio, that's more for people that are focused on needing dividends to supplement retirement. And again, we have information on all these things. Let's maybe just hop next one here. Risk management. Jason, do you want to kind of walk through? And by the way, those little dots that you have, I can't see them.
Oh, you can't see the dots?
No, no. By the way, I'll confess here. Blue dot is me, green dot is Jason, because he's obviously in a different jurisdiction than I am, so it's not like we're sitting next to each other. I just can't see the bottom. So, Jason, if
Okay.
I
Yeah. So on the risk management side, I mean, it really starts with the asset allocation and fitting you in that right model based on your risk tolerance. So if you're not willing to take risk, you're looking at the fixed income. If you're willing to take more risk, you're looking more equity focused. But then within each of those buckets, really the key is understanding the source of risk and managing effectively. Um, I mean, you have to take on risk to earn a return. And so it's not that you can mitigate all risk, it's that you have to understand it, understand where the source of the risk is coming from, and try and manage it effectively. And we do that through a number of ways. Diversifying across sectors is a key thing within the equity portfolios. So if you were to look at the S&P 500 index today, it's about 40% tech, which is great when tech's going up, but at some point tech is not going to go up, and other parts of the market, if you're investing in the other parts of the market, that kind of offset when tech isn't doing so well. We actually did see a bit of that in the second quarter, where some of the Mag 7 names started to not sell off, but they've kind of been underperforming the rest of the market. And so that diversification obviously helped the performance and helped our performance through that period when the Mag 7 wasn't doing quite as well. Breaking up our positions in terms of what's core and what's satellite. So companies that tend to be core are companies that earn high return on equity, tend to pay a dividend, tend to be leaders in their space. These are names that we're going to hold throughout the cycle, just a matter of how much we want to hold of it. Do we want to hold 5% of Microsoft or 2% of Microsoft? And then the names that are satellite positions are names that we're renting. Those tend to be more, say, they have more earnings volatility. So their returns can be quite cyclical. And so we know we want to be in that name, but we want to be in that name in the right cycle. And then just on the options quickly, and we'll get into this a little bit more, our ability to generate premiums by writing options, both call and put options, effectively adds return to the portfolio and reduces downside risk because we're out basically kind of think of it like we're adding income or dividend to names that may not offer dividend. Anything you want to add there, Seth, or can I jump to the next
Yeah.
one?
Well, I think I'll just sum up is that, the question everybody should ask is not so much, how much am I going to make or what are the returns been, but how much risk am I going to take here to make a return? And, again, this is not new for some of you that's seen it, but I think given how well we're doing so far into the year, it's just good to reiterate, what is our risk management and how do we look at, risk versus, return.
This is a double dot. You start this one.
Okay. Yeah, I can see it now. I realize what the problem was. I just thought it was good for people like in our main portfolio, the select equity, just to have a look at stuff that's working, stuff that's not. We don't always get it right, and we're not people that only talk about how we buy low, sell high. Listen, sometimes we have a certain thesis and it doesn't work out. You can see that obviously something like Texas Instrument. I wouldn't have thought that would be our best performer year to date, nor would I have definitely thought Boston Scientific would be our worst performer. I think that there is reasons that we own both. And, Jason, do you want to maybe, talk a little bit more about how we look to manage the downside when it comes to, a name when it's not working out?
Yeah. So if we kind of look at some of the names that have underperformed, where there's opportunities to write covered calls or cash covered puts, that's allowed us to generate some additional income, which effectively will offset some of the downside loss. Like for example, Microsoft right now, off 20% year to date, is now trading at one of the cheapest multiples it's traded in almost 20 years. And so when we're thinking about Microsoft, are we happy to buy it at these levels? Yep. And so are we happy to take some extra premium from writing cash covered puts against it? Absolutely. In the case of Boston Scientific, this is, I guess I'd call it a value trap, Seth. I think we were kind of caught off guard on this one. It's come off quite quickly, and we're scratching our heads on that one. We're giving it one more quarter to kind of turn things around, but otherwise, we're going to have to do something with that position. The good news is that we have a lot more winners and losers, and there's plenty of realized gains that we can use it to offset that loss.
And I think something I just want to add to that is that, two of our biggest losers are in healthcare. I mean, it's a sector that, like energy at the beginning of the year, that we were wanting to get overweight in, and that we felt that the valuations were compelling. But sometimes the valuation, it may look compelling, but the goods don't kind of work themselves out as we expect. In this case with Boston Scientific, it's one of their drug applications that aren't faring as well as what I think analysts had hoped. But again, we'll make that decision after this quarter. I think on the other side, oh yeah, yeah. Well, we can flip to the next one. I don't want to. I want to get into the good stuff here too. This is just something just showing a couple examples of option writing at work. Again, I think it's important for those of you that are in the pool, the select equity pool, to understand how we use options to lower volatility and increase return at the same time. Um, if you notice with Uber, I think we were down about 11%, but
That's year-to-date return. Yeah.
yeah, sorry, year to date. I actually we're not down a position, but you can see how writing option premiums have added about 2.5% return. And so it's something that kind of smooths the downside. At the same time, we just picked Texas Instrument as one that we've written a lot of options on, and it's estimated that's added about just over 3% return to that stock holding. Again, the idea with options, we're not there to speculate. It's something that is meant to reduce risk and add additional income in the portfolio. And this is something I think we've done rather successfully since inception of this pool 3 years ago.
Yeah. Yeah, and you can see, so for Texas Instruments case, we added it, we were patient for a year. We thought it started to get cheap at these levels, so we wrote puts against it. We wrote a put here and we're signed, and then we got this nice, once kind of the thesis was realized, we got this nice pop in the stock. We had written calls, covered calls at I think 280, and were sold part of the position. And just recently wrote a 380 call on Texas, and it's currently trading around $300. So nice way to generate premium. Even nicer when you don't get a called away. But in our case, when we're writing against a position, we're writing at levels we're happy to sell at, we're happy to buy at.
And yeah, same thing with Uber. You can see where we initiated the position on it and all the option writing that we've done, which has been quite a bit actually. Both puts and calls. So
yeah.
All right, let's get into the topic of the day, the headline, the big thing that everybody is obviously can't miss. Jason?
Yeah, so I think it's important to kind of reiterate what we talked about in our last presentation. We've seen this time and time again. When there's conflicts in the Middle East, you get this risk premium in energy shares. The premium lasts for a couple of months, maybe a couple of quarters, and then it comes off. We saw this with Russia invading Ukraine. 4 months later, energy stocks peaked and then trade sideways for a couple of years. We were bullish heading into the beginning of the year of 2026 on energy because sentiment was so poor. We didn't know there was going to be a conflict in the Middle East, but we got that nice pickup in energy shares. And as soon as we, kind of got that conflict a few months later, we're like, okay, well, that premium's not going to last. Let's start to exit energy stocks. And so we have seen a big pullback in energy. Can't tell you where things are going to go, but typically that premium doesn't stay in the stocks for long. One of the things we kind of were looking at why we thought energy prices would come off back to more normalized levels. If you looked at the forward curve of oil, so this would be if you were looking at oil prices today, this is what the price you see on your television screen when they quote how much oil costs. And this slide's from last webinar. So at the time it was at $110 a barrel. But oil prices for delivery 6 months from now, 12 months from now, we're kind of closer to the levels where they were pre-conflict, which was telling us that this was going to be more of a temporary shock rather than a long-term demand destruction or supplies destruction that would impact prices over a longer period. And so that was one of the reasons we started to get, took some profits on the energy sector.
Yeah, and just one thing, this chart was from earlier than a year when the conflict started. If you kind of roughly look at where the date is kind of halfway, it's almost exactly where crude's trading today, and that's with this conflict flaring up again in the last couple of weeks. So The futures market isn't always perfect, but it does a pretty good job of telling you where crude prices are going.
Yep. And here's the round trip we see on oil. Conflict spiked to 120. And then 4 months later, we have returned to basically pre conflict levels. Obviously, we've got a little bit of spike here because of the volatility that's happening, which is going to continue to happen. It's going to be on again, off again in the Middle East. But
Yeah.
markets are largely able to look through that.
I also think, just to add to this, is that people say, yeah, but with all this uncertainty, how can this be happening? Well, one thing I will put out there is that we have an amazing ability as humans to figure out logistics when pressed to do so. And what I mean by that is, there was a lot of talk about the amount of oil coming off the market. Well, there was like 3 or 4 surprising things that have happened over the last couple of months that I never knew or really thought about last year at this time, let alone going into the conflict. First off, turned out Saudi Arabia had a pipeline that could move 7.5 million barrels a day to the Red Sea. Apparently, it was built in the 70s and has been, mothballed, and they put that on. The UAE had another pipeline that turned out that could move 2 million barrels. And in the month of May, and we'll find out for June here shortly, but turned out the U.S. government, with their Navy, was moving over 100 million barrels of oil through the Strait, which that didn't make any headlines or any news or anything like that. And then last, you had China, whose demand for oil imports dropped something like 40%. So you kind of put that all together, it helps you understand why, even though the headlines can look scary and there's can be some fear out there's plenty of oil out there in the world. It's just a matter of humans come up with logistics on how to move it.
Yeah.
And in this
And you
case,
think maybe 3 years from now, you think about Venezuela and maybe even Canada producing more oil.
and even Canada, which we're going to talk about Canada.
So again, the conflict is background noise at the moment. It's going to cause near-term volatility. We are going to see these flare-ups. The market is largely looking through it because the market's more focused on earnings. And if you look at earnings growth, which we'll get to in the first quarter, I mean, even when the conflict was going, you saw earnings quite strong. I think the good news on the economic front is that oil prices returning to $70 a barrel. We've seen a better print on inflation measures. We also saw the PPI number today, which is the producer price index, came in better than expected. That gives the Fed a little more leeway. Maybe you won't have to hike rates, maybe on hold, maybe we do get a rate cut. But there was initially, when we had that big spike in oil, big concern was that the Fed was going to raise rates. And that's when we saw lots of bond market volatility, equity market volatility. And so now the markets, I think, have largely digested that, and we can kind of move to a narrative where rates are probably stable, maybe moving lower.
And in Canada, of course, we're seeing the prospect of rate hikes earlier this year. Again, they were neutral here this morning with no hike. So
Yeah. So we've got all these kind of things happening, headlines distracting us from the important things in the market. And we have a short video here that I think kind of helps us understand why it's important to focus on what matters. So we're going to see if this works here. See, of course, why does it not work? Oh, here we go.
there we go.
The monkey business illusion. Count how many times the players wearing white pass the ball. Correct answer is 16 passes. Did you spot the gorilla? For people who haven't seen or heard about a video like this before, about half missed the gorilla. If you knew about the gorilla, you probably saw it. But did you notice the curtain changing color or the player on the black team leaving the game? Let's rewind and watch it again. Comes the gorilla, and there goes a player, and the curtain is changing from red to gold. When you're looking for a gorilla, you often miss other unexpected events.
Yeah, I completely missed the gorilla first time I saw it. And just go to speak, like, if you're so focused on one thing, you can miss a lot. And I think a lot of people are focused on headlines and not looking at what's important, which is what drives equity markets. Which is really earnings. Looking at Q1 earnings, 28% year-on-year earnings growth. Market was expecting 13. Full year earnings now projected to grow 24% year-on-year. Big contributor of that, obviously, is technology. They're spending billions and billions and billions building out these data centers, but that has trickle-down effects across the broader economy. You need laborers, you need software, you need materials, you need energy. And so you're seeing like the rest of the market also benefiting from that technology spend, and just general US economy doing relatively well. Yeah, so just looking at earnings, 24% earnings growth this year and projected for next year now 17%. And we've seen a broadening outside of the Mag 7. So looking at the rest of the S&P companies, looking at 19% earnings growth year on year. So this just isn't a tech story. Why is the US market doing so well? Well, US consumer continues to spend. If you look at US consumer, the top 10 income earners represent half of the US retail spending. And they're still doing very well, not impacted by inflation. You've got billions of dollars being spent on CapEx for the build out of data centers. You're just seeing an economy that's doing quite well, supported by this kind of secular trend in AI.
I think one thing to just highlight, although you kind of put the red circle around the 2026, just look for folks, if you can see on 2023, how it was really the Mag 7 that carried earnings for the S&P 500, and just what a change for basically companies at large in terms of their earnings growth profile. This is bullish, right? Yes, there's a lot of fear out there in the market. There's things to worry about, but when you see this kind of broadening of earnings growth, it's something you got to take note of, and that's hard data. It's not speculation. It's not feelings. It's not sentiment. It's reality. Speaking of
feelings. There you go. That's a nice lead in.
It was, and I couldn't remember which slide was coming next, whether it's this one, the other one. But Jason, I'll let you kind of go through the pointer on this. But just looking at the picture without even looking at the numbers, right now you see record low sentiment, right? And how bad is that sentiment? It's as bad as it was in 2008, 2011, almost 2022, the 70s. And so when you kind of think about what's going on right now, and you kind of have to ask yourself, like, is it really as bad as it was in 2008? But here's the thing: when sentiment's this low, Jason, what comes next?
Typically rallies.
Yes.
Yeah. And definitely not tops.
Yeah. And I mean, Jason, you can point out a few of these. You can see some of these rallies off these sentiment lows. I menow, they're pretty material. That this
2009. From 2010 to now, 2010 to I think 2016, there was a 6 times earnings growth, or 6 times 6x in the S&P 500, off the low of COVID. We're at four times 4x.
Yeah.
So
yeah. In fact, it's interesting. Sentiment's not even as bad as it was during COVID. And I think COVID was a much more uncertain situation because in April we didn't have a vaccine at that point and didn't know exactly how things were going to work themselves out. The flip end of this to note too is look at the tops, right? January 2000 sentiment, was in an all-time peak, euphoric. There you go. Yeah. And, it's a thing where it's not that markets always sell off when everybody's feeling great, but typically when sentiment's high, that means markets have been fully priced in going forward.
And then just on the shorter term measure, the investor sentiment was in the fear area when I put this together. It's now in the neutral zone. So I guess we're kind of in the not too worried, not too greedy, not too fearful. You can kind of see how this kind of bounces around. The lows in April, you had extreme fear, and then you had a nice rally in the market. And typically when you're at excessive greed, you probably have a bit of a pullback coming in the markets. So right now we're kind of sitting right in the middle.
Yeah.
And on Canada. All right. So maybe things are changing, Seth?
Yeah. So look, for those of you who have been on our calls, one of the things that we aptly pointed out is Canada has vastly underperformed the rest of the G7 nations in general over the last call it decade or so, and part of that's been lack of capital investment. It's been lack of productivity, elevated unemployment, and general outflows of capital going out of the country, not coming into the country. Our new leader, Mr. Carney, Prime Minister Carney, is looking to change these things. There's so far been announced 400 billion or so of projects. Again, I will fully celebrate once we see the picks and shovels in the ground. And I say that with a little bit of pause, is that we've seen a number of announcements over the last decade where things have been canceled, delayed, or in the case of things like the TMX pipeline, the government having to take it over, and the cost went from 4 billion to 35 billion to build it. And so I'm optimistic. I guess you have to be as a Canadian, particularly given what we've kind of seen over the last decade. I'm optimistic that that I think the geopolitics have shifted, and that we'll actually see things getting to work. Again, I will do the victory kind of clap once we see picks and shovels in the ground. But I think it's a very important note because it does speak to investment opportunity in Canada going beyond just the traditional banks and pipelines. There's companies like Aecon, for example, one of our best performers this year. They're involved in infrastructure, they're an infrastructure company. And I think that, some of our contacts on the technology front are pretty excited about some of the procurements when it comes to technology upgrades throughout various government departments, particularly around AI. They are seeing opportunity that they haven't seen in many, many years. So stay tuned. Maybe we'll get out of this technical recession and we'll bring capital back into this country, and really self-actualize our full potential. We wanted just to highlight this, and it kind of goes back to the energy trade. So you look at the returns year to date, but we also want to show for the last quarter. So we know what's worked this year in Canada, but I think what's important, again, if you remember those charts we showed before, is that most of the returns in energy, well, not most, all the return in energy was made up until March of this year. And pretty much since then, it's been a negative return experience. Same thing with materials, gold, mining, and what have you. What is interesting, and again, we're overweight, although we did take a little bit of money off the table recently, is financials. Financials been on fire this last quarter. And again, if you look at, kind of work that back, most of that return, has come in this quarter, not the first quarter of the year. Healthcare, I'm not sure what exactly shows up in the healthcare sector. Is it still marijuana stocks or?
I think there's one, and then there's that large pharma company. Can't remember what it was called.
Yeah.
They changed Valiant, whatever they changed their name
Yeah.
to.
Well, for us, again, what we're more focused is on U.S. healthcare, information technology, no surprise there. Consumer discretionary. I mean, there's another one too where had a slow start to the year, but is obviously is done well. Aritzia has been a name that's been one of the big performers, which of course we own. And so, anyways, I think it's interesting to see the flip on a couple of these sectors that again were top performers in the first quarter and have gone to the bottom in the second quarter. You can't talk about Canada without talking about the loonie. All I'll say here is that there's a lot of negative sentiment in the last while against the Canadian dollar. There's a rather large short position out, so people betting that it's going to go lower. The reality is if those picks and shovels start going in the ground, and we start seeing the economy pick up again, I think this may actually be a bit of a bottom on where the Canadian dollar is going to trade. It's not they can't trade lower, and we don't know exactly where it's going to end up, but I wouldn't be surprised to see the second half of this year that the Canadian dollar strengthens against the U.S. dollar. Jason, you want to wrap this up with the bottom line?
Yeah. So this is taken from our Outlook piece at the beginning of the year. And again, we're just highlighting what's changed. And to reiterate our outlook for the year, we've been expecting the AI CapEx to drive a lot of market return. We've been seeing that, although we've seen a bit of called a Mag 7 taking a well-deserved rest in Q2. We've been expecting kind of more of a broadening across the rest of the market. I think we're seeing that. You can see that in the evidence of the earnings growth of the rest of the S&P 500. We were expecting the Fed to cut rates this year. Market seems to be comfortable with the idea that they're not, and hopefully not going to be tightening conditions. And then on the consumer, continue to be a K-shaped consumer where you have the top end of the income earners doing quite well and the bottom end struggling. There has been a number of tax measures to help the lower income earners through the great big beautiful bill. Fortunately, a lot of that's been offset by the higher inflation, higher oil prices, but broadly the U.S. economy is doing quite well. And we got to focus on what's important. That's earnings growth. We are still in a bull market. Some of the best market returns come late in the bull market. Whether we're late or mid-cycle, we don't know. But if we see like some really big moves and kind of euphoria in the market, that's kind of some signs that we are probably getting to a later stage of the bull market. So it's important to stay invested. We could see some really good returns as euphoria comes into the market, kind of like in the late 1990s.
Yeah, and I'll just say that given that sentiment is so low right now, we still have, I would say, a few innings to go before we see something like the 2000 peak in sentiment. So, with that being said, I think that's all we have. If people have questions, it's all anonymous, so you can send us a question if you have one, or raise your hand, or send us an email afterwards if you want to. We will be sending again copies of the presentation along with the recording to everybody. And if you want to share it with somebody, you're more than welcome to. We're also putting these up on YouTube, where you can watch it off our YouTube channel. I think it's Cadence Financial Group is the channel name. Okay, I don't see any questions coming up here.
I can ask you a question, Seth, while we wait, see if there's anything.
Okay.
So when you watched that video, you saw the monkey. You saw the gorilla?
I saw the gorilla the first time, yeah.
Yeah. How many did you count? Did you get the ball count correct?
No, I got 13.
Oh yeah, I got about
And
13.
I knew about the ball count, and I forgot about the. By the way, folks, I've watched that video probably 3 or 4 times. I still forgot about the curtain changing, and when I realize now, all three of those things are happening at the same time.
Yeah.
So I actually think that the mind, and you're doing a fourth thing, trying to count the balls, and you got three things going on. I think it's an excellent also test showing that multitasking doesn't work. So those who think that multitasking, is a way to get things done, watch that video again because it's very difficult to do four things at the same time.
Yeah.
Alrighty. Well, I think we got a bit of a silent crowd. Hopefully we've given everybody what they need to understand kind of what we're doing going forward. And then for those of you that are soccer fans, we apologize for interfering with you watching the game. We appreciate you being on this call, and have a wonderful day.
Thank you.